ठीक है. Next one is your rupee denominated bonds. Heard about this? Also known as Masala Bonds. Remember? Masala Bonds. Issued by IFC. What is IFC? It is one of the arm of World Bank Group. World Bank Group. World Bank is different thing. World Bank only IBRD. If you have World Bank Group, there are 5 institutions. IBRD, IFC, MIGA, IDA, and ICSID. We'll explain in organizations. So one of the arm established in 1960, International Finance Corporation. This IFC, the part of World Bank Group, issued Masala Bonds. Masala Bonds in the London Stock Exchange. These Masala Bonds are simple, you can understand the reverse of FCCB. It means these are rupee denominated bonds issued in the foreign stock exchange. So FCCB for foreign investor. This is for NRI investors or Indian diaspora. Rupee denominated but bonds issue in terms of rupees in foreign stock exchange. Nothing new in this. But the term is known as Masala Bonds. Here the important fact is, it is not issued by India. It is issued by IFC. So this may come in one of the statement just to confuse the student. So we'll write rupee denominated bonds, also known as Masala Bonds, issued in the foreign stock exchange market, in 2013 by an arm of World Bank Group, known as IFC, International Financial Corporation. First off, these bonds are available in terms of rupees. These bonds are available in terms of rupees. So understand the concept of FCCB. The concept is same. Depository receipts. You heard about this? ADR and GDR. American Depository Receipts and Global Depository Receipts. These depository receipts are simple. Suppose, for example, there is one company, ABC. This is India. This is United States of America. This is company ABC. This is suppose American Bank. This is Indian Bank. And this is American company XYZ. ध्यान से सुनना. If this company wants to sell its share in the foreign market, but this company does not know this, So this will approach American bank, and American bank will sell the share of this ABC company on behalf of this ABC company in the American market. So if suppose this company purchases the share of ABC, so XYZ company will purchase the share of ABC company through this mediator, that is bank, then this bank will give depository receipts to this particular ABC company, and this XYZ company, the flow of capital will only go to this bank. So the benefit of ADR or GDR is that funds will remain in the domestic territory of the country. There will be no outflow or inflow of funds. So funds will remain in the territory of USA, because this bank is selling shares of this ABC company in the American market. So obviously if this will sell share, this will hold share, and the funds will go to this bank. Getting my point? So funds are not trading or not flowing from one country to another country. If this is happening in America, this is known as ADR. If this is happening other than America, this is known as Global Depository Receipt, GDR. There are also concept of IDR, EDR. EDR is European Depository Receipts. IDR is Indian Depository Receipts. Any doubt regarding this? Buyback of share is a different concept. Here will not come, because they are just doing, they are just taking help of this bank in selling the share in the American market. If this company will directly purchase the share in ABC market of ABC company in Indian market, so obviously funds will go from America to India. America will experience outflow of dollar, India will receive dollar. If these companies are unknown to each other, so there is a trust deficit in the working of ABC, in the mind of XYZ. So just make an intermediary. This intermediary will give an extra cushion. So whatever the trust deficit between ABC and XYZ, this bank will bridge that trust deficit. क्या हो सचिन? The face is not looking. What's the doubt? Ask. Confused or you? So you will write something. If you will not get, again I'll explain. I'll take 10 minutes extra. Is there an issue? अब हो ही जाएगा ना, इसको explain करना है दोबारा से, या otherwise after the class. Okay. So you write depository receipts comes under two category. If it is issued in America, it is known as ADR, American Depository Receipts. Write fast a little bit. And if it is issued in countries other than America, it is known as GDR, Global Depository Receipts. Draw this, then I'll explain. Draw this, then I'll give you the explanation of this chart. Yes, fast please. Oh. Done? If a domestic company ABC wants to sell its share in the American market, if a domestic company ABC wants to sell the share in the American market, then it will take the help of any American bank. Then it will take the help of any American bank in issuing ADR, to the ABC company, in issuing ADR to the ABC company. Full stop. The XYZ company of America, the XYZ company of America can purchase ADR from that American bank, can purchase ADR from that particular American bank. Full stop. The reason behind this is that company ABC and XYZ, are unknown of each other, and there is a trust deficit, between them, Full stop. That American bank who is issuing ADR will bridge that particular trust deficit. I hope it is clear now. No. What's the benefit of ABC? Because ABC, this bank will issue what? ADR. So ADRs are the asset. So the value of ADR will go up. Obviously, whenever they will redeem, they will get the benefit. But the flow of fund, if XYZ purchase that ADR, that depository receipt from bank will use that fund in American economy itself. Obviously, in terms of whatever they are investing, in terms of suppose dollar or rupee, it depends on the depository receipts. You heard about P notes, participatory notes? I'll discuss this after that. This is the last topic, participatory notes. Participatory notes are the simple same concept as depository receipts, but there is only one change. In participatory notes, there is an anonymity of the depositors. So here, if I know that ADR is purchased by ABC company, but in case of participatory notes, there is the anonymity of the investors. You will not get the name of the investors. So participatory note is the best example. That is why India received huge inflow of funds between the period of 2003 to 2008 due to the reasons of round tripping, etc. ठीक है? So you write participatory notes, then I explain. Participatory notes are the same as depository receipts. Participatory notes are the same as depository receipts, but with one exception. That is the anonymity of the investor. While participating in P notes. Now just understand this concept once again. Okay? Suppose this company ABC, I am removing this ABC. Suppose this is Tata. ठीक है, now you'll be able to connect better. This Tata wants to explore the market and wants to sell its share all over the world. So suppose that Tata has chosen USA as the destination. There's one company, any company of America, McDonald's. So if this Tata will sell that, will contact this bank that I want to sell my shares in the American market. So this bank will give ADR, American Depository Receipts, that whatever the amount of shares I am able to sell in the American market, I'll give you equivalent amount of money. I'll give you equivalent amount of money. But that too after selling off all the shares. So this American bank will get the right to sell the share in the American market. Share belongs to Tata. So whatever the share they will sell, they will raise fund. It means banks will get some fund. Now here, if McDonald's does not trust Tata, getting my point? If McDonald's does not trust Tata, but McDonald's do trust this bank because this bank belongs to America. So this McDonald will give some money to this bank. So according to McDonald, there is no outflow of funds. McDonald is not purchasing shares of Tata. Getting my point? Directly. But McDonald's is purchasing domestic shares because these shares are issued by American bank, not by Tata directly. Getting my point? यहाँ तक सब समझ में आया? ADR है ना, ADRs हैं, depository receipts हैं, they don't know. But here the anonymity of the investor is not here. Investors are known. टाटा को पता चलेगा मैकडोनल्ड्स ने खरीदा है, ओके. एंड पी नोट्स में क्या है? नो वन नोज हु इज इन्वेस्टिंग. दिस इज द डिफरेंस. दैट इज व्हाई दैट राउंड ट्रिपिंग, फंड्स कमिंग फ्रॉम मॉरिशस एटसेट्रा, बिकॉज हु नोज that who is investing in Indian market? No one knows, because of the anonymity of the investor. We cannot put restriction on P notes because then what will happen? We will not receive foreign funds. So that is why RBI had to continue with this P notes. P notes are big trouble because I told you there is unofficial data that if there is 25% of the outflow of FII at the same point, it means on one occasion, if 25% of FII will withdraw fund from Indian market, what will happen? India will not be able to repay that. If you still have any doubt, we can understand after the class. Thank you so much. Have a good day.